let's move on. Let's share what we think is a typical FP&A calendar month. So this is not a standard. So you may see different calendars in different companies. It all depends on the maturity of the company. So if it's a very large organization, it has been there for say 50 years or 20 years, you might see a very advanced FP&A calendar. So a lot of activities happening in week three is happening in week two in that company. A lot of activities in week two in normal companies might happen in week one in that company, just because they are so all processized and they've been in existence. So one factor is it depends on the size and the age of the organization. The second factor is also the size and the age of the FP&A team. More on the age of FP&A team. So if it's a very new FP&A team, they might not be doing all of the things that they should be doing in week one in week one. They might be doing it in week two or week three just because they are new. But over the period of say 2 years, 3 years, once the FP&A team matures, this is what we see as a typical FP&A calendar month. So this will not be exactly the same if you go into a new organization or if you go into a organization where the FP&A team is very new because they are still implementing a lot of things. So this is a mature stage FP&A calendar. So what happens in week one usually is uh, actuals for December. So we'll take the example of January and we'll take example of December as the last month. So actuals for December will take time to close. So it takes usually 3 to 4 business days in most companies. Some take more, some take less. So on an average, it takes 3 to 4 business days for actuals to close. So in the meantime, what FP&A team does is they share a flash report for the business day one or business day two, business day three, which is an estimate, which is a very close estimate of what the actuals will close like look like. So it might be all the data from the system except pending adjustment entries, or maybe if the data is coming at 2 3 days lag, say you have data for say until the 27th of December, and the last 3 days data will come eventually. So you have 27 days of actuals, and then you do an estimate of the last 3 days or 4 days, and that's how you send a flash report. Why it is called flash? It is called flash because you typically send this more frequently than your month-end reports or your quarter-end reports, which are sent once a month or once a quarter. So that's why it is called flash because it's reported on a daily basis. In some cases, it's reported on a weekly basis. So that was flash reporting. Now, after business day three, four, the accounting team, in cases where there is a separate accounting team, in cases where there is no separate accounting team, there's only one team, which is a smaller, in case of a smaller company, they together will close the books of account. Once the books of accounts get closed, they will together review the actual numbers for December and compare it with the budget and the forecast that they had done for that particular month. So that's the accounting close review where the accounting team and FP&A team they come on a call and they review. Okay, these are the actuals for December. This was the budget. This is the variance. So what was the reason for variance? So a lot of the variance analysis actually happens in week one. It doesn't wait until week two. In most companies which are mature. So if the FP&A team is mature, they do that in week one itself. Now, once that accounting close is done, uh, they start preparing all their regular business as usual reporting. So whatever the reports that need to be sent out to senior management, which are done on a monthly basis, they can do that because they have all the actual data, they have all the comparisons. So week one, typically they also complete the month-end reporting packs and business variance commentaries. What happens is when as soon as they start seeing some variances in the flash report, they immediately reach out. They don't wait till the actuals to close. So by 27th of the, if you have say first 27 days of the data or 28 days of data in the flash, you will have some sense of the variance that will happen at the month end. Like you'll know, okay, because of the 28 days of actuals already happened, there will be some variance in the month end number. So you proactively reach out to the business on emails. In some cases where there are automated tools, a notification automatically goes to the email, like the business member or whoever is the person who's responsible for that particular product, that particular department, that okay, this is the variance between actuals and this was what had we had planned. So what do you think? What is the reason? So that commentaries collection even starts before the month end is closed, because you already know there is going to be a variance. Now it may be possible that you can find that variance yourself. So you may go into the ERP system and you can find out that variance. Okay, this is coming from this department, this particular product. Then you will have to reach out to that department head or whoever the manager is on the phone, on the email, on the Zoom call, whatever, and understand why that variance is happening. Not just understand why that variance is happening, but what can be the impact of that variance in your next forecast that you do. So one thing is understanding what the variance is, why it is happening, and there's another part where if you see that is going to continue in the next month or next quarter, you will also need to make sure that you adjust the forecast. You will also make notes of how it is going to impact your next month or next quarter. So that is month end reporting and commentaries. And in quarter end, especially in companies which are listed companies, they have a lot more reporting activity. So they do a quarter end report. Some companies, I think most companies which are listed, they also do investor presentations on quarter ends. So there are some reports that are specifically for quarter end. They'll only come once in a quarter. Week two is all mostly forecasting. So week one, everything actuals related get closed. Now you know what the December numbers are. Based on that, you can adjust your forecast for the next month. So, for example, in this case, we'll consider an example of an Indian accounting calendar. So it's April to March, and 9 months have already gone. December has closed. Now you have to update the forecast for the next quarter based on whatever you see in December. So you already updated this forecast maybe November end when you saw the November actuals. Now after December end, you will again revisit this forecast and make adjustments to that forecast. So how that process typically happens is, first step is the finance team will prepare the preliminary forecast based on the actuals that you've seen from week one, based on the conversations that you had with business managers on the variances. So you know, okay, this variance happened, it might happen in future. So you adjust the forecast based on that. Now, once you do that, you will review that with the business. So once you do a preliminary forecast, you will go on to a Zoom call with business, or if you're in person, you'll book a meeting room and you'll ask the business, okay, this is the updated preliminary forecast for January to March. How does it look? So business will give their feedback. They will say, okay, this looks okay, you can go ahead. Or they might say, okay, although you made this assumption, but this assumption holds true for December, but this might not happen in January. Or if you've not made some assumption, if you missed out something, they might point out to you, okay, why do you think revenue is so high? Because this month we'll not have this, say, we'll not have this particular product sales because of some reason. So you should not consider this product sale too high. They'll give you some insight, some analysis, some things that they can see in the forecast which you may not be able to see. And the only reason is because they are very close to the business. They are doing the selling, marketing. They know more than finance. They will be able to help you on adjusting your forecast. Now, once that process is done, the third step is that it gets reviewed with the CFO. So the CFO also reviews the forecast, and also the somebody from the leadership will also review it in most cases. Once that review is done, that forecast is locked and it is uploaded in the system. In some cases, it is uploaded in the system where people work in Excel and then they upload it. In other cases, if the forecast is itself done in the planning tool, you don't have to upload it. It's already there in the tool. You just have to lock it. So there is a process where you lock the forecast. Now, from that point onwards, that version of the forecast gets locked, and the next version will be updated in the next month end, which is January month end, when you get January actuals in the first or the second week of February. So that's the forecasting process, which happens now. Week one, week two, you've done all your reporting, you've done all your actuals, you've done all your forecast. Week 3 is slightly lighter in terms of workload, so it's more of what things that you need to do in terms of automation. So in order to make your week 1 and week 2 more more efficient next time and going forward, you do spend a lot of time on automating stuff. This is also the time where you get to interact with the business a lot. It doesn't mean that you don't interact with business in week 1 and week 2, but typically what we see is people are so busy in week 1 and week 2 that they'll tell the business, okay, we are busy closing the books or we are busy with the forecast. If it is not urgent, I'll come back to you in week 3. But it may be that business, it has to be across week 1, week 2, week 3. It's just that you do more of it in week 3 and less of it in week 1 and week 2. It doesn't mean that you don't do that in week 1 and week 2. Supporting the business, special projects. A lot of uh, companies these days have cross-functional projects, and finance is a critical part of these projects. So you will might be working on a project which involves people from different teams like sales team, marketing team, and they need one finance person to be there just because finance is required as a part of that project. So you work on a lot of special projects which adds a lot of value to the business. Working capital management, if there is no separate treasury team, you also take care of working capital management, which is your in a manufacturing company, it's related to your receivables, inventory, um, payables, all those managing cash flow. So if there is a separate treasury team, they might do it. But if there is no separate treasury team, especially in mid-sized company, there is no separate treasury team. So FP&A team also does a lot of working capital management and recharges. Recharges, as Dhaval explained, it's uh, making sure that you allocate the cost correctly and you make sure that the cost gets booked between different legal entities and different departments correctly. If one department is spent on behalf of other department, you need to allocate it and recharge it accordingly. We will cover all of these in detail in week 3. So don't worry, we'll cover it with examples. We'll have an example for recharge. We'll have an example of forecast. We'll have an example of management reporting. So we'll do that step by step. And week 4 again, it is preparation of week 1 and week 2, because week 1 and week 2 will be very busy. You do a lot of preparation work which you can do ahead of time in week 4. So you start doing the flash reports not from business day 1, you start doing it from the the 28th or the 30th of 29th of the month itself. So you start doing that last few days of the month for the next month. You also help. So all these accounting close, revenue close, you don't do it as FP&A if there is a separate accounting or a separate controller team in your organization, but you do support the accounting team because you are more close to the business than accounting team. You have more interactions, touch points with the business. You will be in a position to help the accounting team to come up with the correct accruals. You will be so accounting team will reach out to you. Okay, this is the accrual number for this month. What do you think? Is this right? So then you can look at your budget tracker. Okay, this was my budget. This is what actually they have spent. They have spent this much extra, so we need to accrue for this. So those kind of things you will be able to help the accounting team with. So you will not be doing the revenue close, AP close, accruals, prepaid yourself. Accounting will be doing it if there is a separate accounting team, but you will be supporting them, helping them with whatever data they need, and you continue to support the business, meeting business partners. Risk and opportunities, as I mentioned, if you notice something in actuals that will continue in next month, then you have to highlight that as well and adjust your forecast accordingly. So if you notice something in week 3, week 4, you have to keep that note somewhere so that when you do the next forecast, you adjust that as well whenever you do it in the next month's week 2.